U.S. debt ceiling crisis, an urgent warning to investors. Crash incoming? Tick-tock, tick-tock. Do you hear it? The sound of time slipping away, counting down to a moment that could change everything. Welcome, ladies and gentlemen, to a story of high stakes, where the fate of an entire nation's economy hangs in the balance. Today, we dive deep into the heart of a looming crisis, a ticking time bomb that threatens to shatter the very foundation of our financial world. So, will our leaders rise to the challenge and avert this impending catastrophe, or will we witness the unraveling of our economic stability? New findings from both the Congressional Budget Office and the U.S. Department of the Treasury sound the alarm bells, indicating that the United States is swiftly approaching a critical point known as the X date, when the government will no longer be able to meet its financial obligations. It's like a ticking time bomb for the economy. We've seen in the past that even coming close to breaching the U.S. debt ceiling can send shockwaves through the financial markets, wreaking havoc on the lives of ordinary people and businesses. And guess what? The situation is already taking a toll on the markets as we speak. Real-time data reveals that investors are factoring in the political brinksmanship surrounding the possibility of a federal government default. They're demanding higher risk premiums, which is a clear sign that trouble is brewing. But let's not even imagine what would happen if the U.S. actually did default on its debts. It would be catastrophic. Experts from the Council of Economic Advisors and independent researchers warn that such a scenario would slam the brakes on the economy, causing it to spiral downward at an alarming rate. The longer this breach lasts, the more severe the consequences will be. We're talking about millions of job losses, folks. We can't afford to underestimate the gravity of this situation. It's time for action, for swift and decisive measures to prevent our economy from plunging into darkness. The stakes are high, and the consequences of inaction would be devastating. Let's hope our leaders can come together and find a way to avert this crisis before it's too late. Our economic well-being hangs in the balance. Let me break it down for you. If our government defaults on its debt, we're risking undoing all the incredible economic progress we've made since the current president took office. Just think about it. Unemployment rates at a historic low, over 12.6 million jobs created, and a strong, steady growth engine fueled by consumer spending. People are earning decent paychecks and their financial situations are looking good. But here's the scary part. If we breach the debt ceiling and fall into a recession, the government would be unable to implement measures to counteract the economic downturn. That means there would be limited options to help households and businesses weather the storm. Imagine the struggle for regular folks, especially small businesses, to borrow money to cushion the blow. They would be left in a tight spot. And brace yourselves, because interest rates would go through the roof. That means higher mortgage rates, credit card interest rates, and even rates on Treasury bonds. Ouch! Let me tell you, this isn't a situation we want to mess with. Historically, Congress has always stepped in and raised or suspended the debt ceiling before we hit that X date. But economists are unanimous in their warning. If we let this happen, there would be a complete economic catastrophe. A catastrophe we could easily avoid. Don't just take my word for it. Experts at the Brookings Institution have laid it out plain and simple. If the government defaults, it will cause major disruptions in financial markets. Picture stock prices tumbling, people losing confidence in the economy, and a significant squeeze on access to credit. And guess what? We're already seeing the warning signs. Yields on short-term Treasury bonds have shot up since April, directly impacting the government's borrowing costs and, ultimately, the taxpayers' pockets. So, folks, it's time to pay attention. We're at a crucial juncture where the decisions being made by our leaders can make or break our economic well-being. Let's make sure they understand the gravity of the situation and take the necessary steps to avoid this disaster. We've come too far to let it all slip away. The future of our economy hangs in the balance, and it's up to us to demand action. Hold on, before we dive deeper into the gripping world of the debt ceiling dilemma, we need your support. If you find this video informative, thought-provoking, and downright captivating, then like this video and subscribe to our channel for more exciting content. We want to hear your voice too. Drop us a comment down below, sharing your thoughts, questions, or even your own experiences related to the debt ceiling. Let's continue. Picture this. The cost of insuring U.S. debt has skyrocketed to an all-time high. It's like the alarm bells are ringing, signaling the growing fears of a potential U.S. default. You know things are serious when credit default swap spreads, which measure the insurance premiums for U.S. debt, start shooting up dramatically. But here's the kicker. As we inch closer to the debt ceiling, these market stress indicators are only expected to worsen. Brace yourselves for wild swings in stock and corporate bond markets, making it harder for companies to secure financing and invest in projects that drive economic growth. We're essentially putting a roadblock on the path to extending the current expansion. Now, let's talk about the risks of a brief default. If we breach that debt ceiling, the repercussions will be felt immediately. The chief economist of Moody's Analytics, Mark Zandi, warns of a crisis characterized by soaring interest rates and plummeting stock prices. Imagine short-term funding markets, the lifeblood of everyday credit flow, grinding to a halt. It would be chaos. Fitch Ratings even predicted that the U.S.'s credit rating would be downgraded to restricted default, and Treasury securities would carry a D rating until the default is resolved. That's a huge blow to our financial reputation. Moody's has crunched the numbers, and even a short breach of the debt limit could lead to a decline in real GDP, a staggering loss of nearly 2 million jobs, and an increase in the unemployment rate. We're talking about real people losing their livelihoods. And that's not all. Interest costs would spike, burdening future generations with an economic price they shouldn't have to pay. The esteemed economists at Brookings have estimated that the default could cost us over $750 billion in higher federal borrowing costs over the next decade. That's money that could be used for critical investments in the future. But it doesn't end there. A default would weaken the role of the dollar in the global economy, shaking up currency values and decreasing liquidity. Investors would be wary of holding dollars, creating even more instability. Folks, this is a wake-up call. The implications of a U.S. default are grave and far-reaching. We're talking about the very foundation of our economy being shaken. It's time to demand action, to urge our leaders to find a solution and prevent this economic nightmare from becoming a reality. Our future and the prosperity of generations hang in the balance. Let's not gamble away our economic stability. Let's take a stand and protect it. Imagine the worst-case scenario, a prolonged default. It would throw us into a deep recession reminiscent of the Great Recession. The stock market would plummet, wiping out retirement savings. Confidence would crumble, leading to job losses and reduced spending. Unemployment would skyrocket, and the government wouldn't be able to help. It's a terrifying picture. Moody's predicts that we'd see job growth under a clean debt ceiling increase, but under a prolonged default, we'd lose millions of jobs. This isn't just one analysis. Experts agree on the devastating impact. The consequences would be severe. Governments couldn't provide aid, and borrowing rates would skyrocket. It's a recipe for economic disaster. The U.S. debt ceiling crisis poses a real and imminent threat to investors and financial markets alike. As investors, it is crucial to stay informed, monitor developments closely, and assess the potential risks to one's investment portfolio. Diversification, risk management strategies, and seeking professional advice are prudent steps in navigating the uncertainties brought about by the U.S. debt ceiling crisis. The road ahead remains uncertain, and only time will reveal the outcome, but preparedness and vigilance will be key in weathering the storm. And that wraps up our exhilarating exploration of the debt ceiling dilemma. Before you go, make sure to explore more captivating videos on our channel. We have a treasure trove of insightful content waiting for you. If you enjoyed this eye-opening journey, make sure to hit that subscribe button, give this video a thumbs up, and share your thoughts in the comments below. Thank you for joining us, and we cannot wait to continue this exciting journey together.